This morning's jobs data was better than expected. In fact, JOLTS numbers came out at 8.1 million job openings rather than the expected 7.73, showing an uptick in labor market statistics. At the same time, we saw the ISM Services PMI number come in better than expected, so both of these figures were uptick numbers for the US economy. And logically, the dollar index continued to bounce off of this level of support in response to this data, adding a bit of fuel to the fire, if you will, just adding more strong economic data to the mix, to the picture here recently for the dollar, which again, services PMI, that is a forward-looking indicator of how the services component of the US economy feels about future orders, future hiring, future projected economic outlook. Generally speaking, it's a pretty strong forward-looking indicator of the economy. And so some more strength there has the dollar index looking very strong relative to its peers. But interestingly, this actually caused the stock market to sell off. And I want to show you why that might be. It's a little bit strange. You might say, well, those were good jobs numbers and good services PMI numbers. Shouldn't the stock market actually push higher? And this is where sometimes people get all sorts of confused about fundamental analysis, saying, well, the news came out good and the stock market went down. This doesn't make any sense. But possibly what has the stock market scared today is this huge jump in the 10-year Treasury yield. And here's the thing about that. This number, this strong economic reads this morning, the JOLTS job openings and the PMI numbers suggest that the Fed may not need to cut rates as much this year. That does not bode well for certain areas of the stock market, which had their fingers crossed for rate cuts in 2025. So we do see the stock market, the S&P down about 0.9% here, and the NASDAQ down 1.6%, bringing me back to break even on this position. And if you remember yesterday, I mentioned how it was a good day for me in the markets, but that sometimes good things happen and they reverse right away. Well, I shouldn't have said that, because here we go. The market completely reversed all those gains from yesterday very quickly. So just be, when it comes to this stuff, it's very easy to get caught up in the hype, and just remember, you want to stay long-term picture, long-term vision here. I would actually take these statistics as not too threatening to the overall story, to the stock market. I mean, good services PMI numbers and good hiring numbers are actually, to me, a positive catalyst and should continue to help the NASDAQ push higher. That being said, there's a little bit of wobbliness here as people factor out potential rate cuts this year. It makes people a little bit nervous, as the technology sector plays a huge component of the NASDAQ and S&P 500, and tech is notoriously a long duration investment, meaning, again, tech companies, they have to invest now for the future, and investing means borrowing money. Higher borrowing cost does weigh on, theoretically, tech stocks and companies that require a lot of borrowing money in order to advance and grow their companies. Speaking of companies that require borrowing, here's the Russell. Russell is down again 1.3%, let's call it here today. So good little sell-off here following yesterday's pop. Though, to be completely fair to the indices right now, they all look, from a price action perspective, very strong to me. Even the Russell, I mean, we are seeing a little bit of a sell-off here today, but we found nice support around this 2200 to 250, let's call it, this general area seems to be holding well for buyers. The question will be, can we actually recapture this level of resistance around 2280 and continue higher? For the S&P 500, we have a similar kind of story. We've been in a period of consolidation. Stock market, shot to the highs and then completely sold off on the Fed day, and now just continuing to chop around. What I think your next kind of clear indicator to short-term price direction for the S&P 500 is either, if we can fail out this level of support, we could actually go lower and potentially go test that 5720, or if we actually see price make a stab at pushing through the all-time highs, that would be very bullish and very constructive. So for me personally, I lean more towards the bullish side, as I've been very clear about recently in my videos. I have an active long position on the NASDAQ. Very similar story here. If we continue to push lower and can't hold any of this support, then it is appropriate for me to go ahead and stop out of my position and look for better pricing, potentially even at lower prices. So something to think about. That being said, we've also seen a little bit of resistance here forming on a diagonal. Let's see if we can actually break through the highs here to continue. That would be obviously what I prefer to happen, but doesn't matter what I want to happen. It's about me reacting to what the market is telling me. Overall, on the Edgefinder's top setups page, we do still have a strong reading for the NASDAQ, as well as some other things that I'm watching, oil and USD CHF, which I have a long position on that's working really well inside of our signals group. So yesterday I bought dollar Swiss on the dip, and so far we've had a nice little bounce on this one, but I do continue to see the dollar as more attractive than its peers, which definitely was the right call going into today's prints, where we had two very strong economic prints for the US dollar. And by the way, if you're interested in signing up for our VIP group, you can get access to every trade that I'm taking. We notify and alert our members within our Discord channel. This is something that goes directly to your desktop or to your phone anytime I take a trade. If that's something that would be beneficial to you, if it would help you out to watch along with what I'm trading, this is a service that we offer at my company, A1 Trading, and subscribers get a nice little discount. If you check out the first link in the description down below or the pinned comment, you can send a direct message to our support team who will help you get access to a membership for a very low subscriber discount. If you want more information, send us a direct message using that chat link. And gold at one point this morning was up almost 1%, actually a little bit more than 1%, very briefly. But of course, this dollar strength that came in on the economic news continues to put a little bit of pressure. And that's been the theme for those of you who are wondering, hey, when is gold going to get a bit of a jump start here and start moving again? Well, it's probably going to coincide either with the dollar continuing to strengthen and gold giving out the lows, or again, some dollar weakness coming into the picture and finally giving us the juice to potentially break through those highs. But for me right now, gold continues to be, I know I keep saying it, it's very neutral for me, just really not showing a lot of strength because, again, you've got geopolitical uncertainties and the uncertainties around Trump taking office and all these different kind of worldly things. But at the same time, you've got a Fed that doesn't seem to, need to rush to rate cut because we have such a strong U.S. economic prints that keep coming out. So until that changes, the story is too kind of gridlocked for me to really favor the long or short side on gold. And a really quick way to illustrate that is if I pull up the Edgefinder's gold and silver tracker, what you can see here is that the overall reading for gold continues to be neutral. And you can actually see visually where we're gaining and losing some bias here on gold. So I'll show you this example, and then I'll show you one that's a little bit more clear. So if we look at this one, you can see there's some reds, there's some blues, reds, blues. Basically what this is telling you is that there's indicators like, for example, strong GDP print. That's not very good for gold. So that's going to dock us some points. But then trend seems to be breaking to the upside here recently. Seasonality looks good. So you've got some positive factors. But as a trader that uses a system like this, I want to kind of categorically and systematically look at different factors and weigh all of them together the best I can, right? Rather than just looking at one singular item, I want to look at the conglomerate. I want to look at what institutional money seems to be doing, which is pretty bullish. But then there's other factors that keep me hesitant, like retail sales. Now, I've talked about this recently, but having this checks and balances, if you will, on my trading is very important. It's one of my favorite features of the Edgefinder. So here's an example of one that's a little bit more clear, a little bit more obvious. Trend for the NASDAQ is tentatively bullish. It's not a +2, but it's a soft uptrend right now. Seasonality looks good for January. We've got a score of +6, which coincides, of course, with a pretty solid blue overall rating here on this kind of viewpoint. So this is an example of one where more things are agreeing. GDP growth is good. That should be good for stocks overall. Again, growing earnings, growing corporate earnings, etc. Manufacturing PMIs came in good. We'll have the latest services PMIs update shortly, which will actually turn this blue. So we should even go to +7 on the NASDAQ. This data just hasn't yet updated. That will go blue. So the point is here, you can see an example of a chart where more things are coinciding, where they're more overlapping and there's more confluences here, which gives me extra confirmation when I then pull up the NASDAQ daily chart. Today's video sponsor is Vantage. Vantage Markets allows traders outside of the US to trade CFDs, which will allow you access to trade things like stocks and indices, cryptocurrencies, all in one singular brokerage using their CFD model. They also offer a welcome bonus to my subscribers, and I want to encourage you to check the link down below in the description to check out Vantage, take advantage of that welcome bonus, and see if this broker is right for you. Do your own due diligence, of course. As always, you have many options, and there's several brokers listed in the description, but you might want to consider Vantage as your next option if you're looking for a great brokerage with low trading costs and a generous welcome bonus. So check them out down below. I mentioned earlier that I went long USD CHF, and I picked up a position really at almost the perfect price here. Price has already started to bounce, but I mentioned that I had a dollar cost averaging approach on dollar Swiss franc, and I wanted to clarify a little bit about that. Basically, I like to enter in multiple parts when I'm trading FX. The difference between FX and some of the other markets that I trade is that FX is notoriously over the long term an unbound market. What I mean by that is over the very long term, currencies don't necessarily drift higher or drift lower, right? For example, the VIX tends to drift lower over time, or the S&P 500 tends to drift higher over time. Same thing with gold. But currencies are more unbound. And basically the idea with that is that they're not bound to go up or bound to go down. They can go back and forth for decades. And I actually love that component of Forex for the specific reasons of dollar cost averaging, which is a more favorable thing to do in a range kind of overall market. So I actually have a long position on dollar Swiss with willingness to add more to this long position. I use a dollar cost averaging, which means I take very small initial positions and potentially build a long position or short position based on what price action does next. But it's not purely a price action or mechanical strategy. It also incorporates macro fundamentals. So I've mentioned I'm really bullish on the dollar. So I like this setup and I'm willing to build a position one piece at a time in order to build kind of the position that I'd like on USD CHF. I actually had a great conversation this morning with Forex James, who came on the live stream. So I want to play a little bit of a conversational clip of us talking about dollar cost averaging and the different ways that him and I both use it in our own trading portfolios. How do you, with dollar cost averaging, since you're not using a defined risk stop loss, how do you manage risk?
That's a good question. It's not really straightforward, and I can't give you a set rule because I'll be honest, a lot of my dollar cost averaging is based on intuition and just how I feel about the markets. So my initial entry and sort of the second and third entry will normally be a set lot size. So for example, this is a $10,000 account. So I'm going in normally with a 0.3 to 0.5, depending on how confident I am in the positioning. Then as price moves against me, I'll basically do what it's kind of martingale, but it's a bit less aggressive. So I might move up 0.05 or 0.1 in lot sizes.
I also want to just reiterate too to the audience, if you didn't catch it. So James is using a combination of a dollar cost averaging kind of entry, exit, and risk management process, but he's still overlaying it with the macro. So it's kind of interesting because you're still, mentioning that you're predominantly looking to short something like euro dollar in favor of the U.S. economic data, etc. So you're using that macro layer and then using dollar cost averaging on top of it, which is very similar to what I also do with when I'm trading FX.
Yeah, well, that's the thing. I think if you're going to dollar cost average, it has to have something in its favor. Otherwise, it's fast track to blowing an account essentially.
Sure.
Obviously, mixed with risk management. But yeah, this euro pound one here is a good example because this one went against me quite aggressively. So I went in. I think this was a one lot initial position, then went in with 1.5, then 2, and then 2.5. But the reason I do that is because when I'm in a bad situation with dollar cost averaging, if you aren't able to get out of the position, again, it can get very, very nasty. So when I'm adding on positions at higher lot sizes, all I need to see is a small pullback, small reversion, small move. I can get out at break even or even in profit. So for example, this move basically was 2 losses and 2 wins, but I got out 1% profit because I scaled in slightly larger as price rose and rose.
Yeah. And, the interesting thing too about dollar cost averaging is, I'll give a little bit of my answer to that question that someone asked me is like, how do you manage risk? Well, for me, there's many ways to manage risk beyond just a stop loss. Now, it is very easy for somebody who is new to this stuff and does not know too much to just say, oh yeah, I'll just do no stop loss and it will be, easy money. But when you do have to deal with a serious drawdown, it can get dicey pretty quick. So how do you manage risk? Well, the answer is, in my, experience, what I do, I know something about this market, which is I cannot control what this chart does. This chart could drop off the face of the earth for 6 months. It could get real ugly. How am I going to survive that? Well, what I can control and what we can all trade as traders control is our sizing. So for me, the big thing with dollar cost averaging is the smaller I start, the more I have room to be wrong before I'm ultimately right. If you're dollar cost averaging and you're heavy right here, and then you're going way heavier right here, It only takes one time where the market does not rebound well to crush your account. So to avoid that, my approach is incredibly small sizing and just looking to scale in patiently and not aggressively. And one thing that I like to do with dollar cost averaging is actually put time in between my next trade. Even if this market were to, for example, drop here, and let's say I take a trade and then it's very quickly here, I'm not going to add a second trade too quickly to when I first took the first trade. So I might actually wait an extra day, and that might allow me to actually get in down here for my second trade. So duration between entries, as well as distance between entries and sizing between entries, dollar cost averaging to people who are reckless with it can just be straight up gambling. But dollar cost averaging with a very conservative and risk adverse approach can actually be quite a great way, in my experience, to trade the currency market. So just, there's different styles, different things for everybody. Thanks for watching this video. And on the screen right now, you'll see some other options of other videos we put together that might be helpful to you in your trading career. So thanks for watching, and we'll see you next time.